Let's get the view of our halftime headliner today. It's Dubravko Lakos, JPMorgan's head of global market strategy. He's with us here at Post 9. It's great to have you.
Thanks for having me.
Man, I can't imagine what it's been like for you trying to model all this through. But you did take your target down for the year recently, and you did take your earnings estimate down as well. So your new target, is your base case 5,200? Or is that your base case?
Base case 52, but that's also assuming that tariffs, reciprocal tariffs from April 2nd stay in effect. Since then, we've had change. We've gone from like a broad trade war to a little bit more of a concentrated trade war now, focusing more on China. So the way we've been thinking about it, I think thinking about it just through one number, I think is a foolish game. Because forecasting in this environment, I think is very hard.
Of course. I don't envy the job that you try and do at your best, because nobody can model anything in this environment, and yet you're charged with trying to figure out where 9 months or 8 or 9 months from now the S&P 500 is going to be.
So we're trying to think about it through scenarios. So we basically put a bull case of 5,800. A bear case of 4,000, which obviously would then imply some form of recession and contraction. 52 was sort of more of the middle ground, where you do get a hit to growth, but you sort of, you come out of it and you sort of start thinking more about 2026 as a year where you start to see growth again, right?
Well, because let me just stop you for a sec. Because with your earnings number coming down to $250 for the S&P for calendar year 2025, you put a multiple on that of 20 times, you get to 5,000.
No, but I would think about, if you think about any kind of year-end price target, I think the 2025 EPS number is irrelevant. You really need to think about what kind of anchor do you get in terms of earnings in 2026. 2026 number now is at, I want to say, 305. So you really
Who has 305?
The street consensus.
305?
2026.
I know 2026.
Yeah, so let's say if you shave off 30, 35, 40 bucks off of that number, then you're modeling off of, let's say, a 265, if that makes sense. So that's what I'm saying. As I think that we're basically 1 or 2 months away from people completely dismissing 2025 from an earnings point of view, and everybody's going to start focusing on 2026. Do you have a growth anchor in 2026, or is this now some form of recession that's going to spill over in 2026? Because in 2026, we do have potential catalysts that could help growth get a bit of a uptick.
What's the growth anchor in 26? The tax cuts?
Well, you could get some form of tax cut. I do think the onshoring and nearshoring story that many people sort of completely disregard, I do think there is some partial validity to it. So again, if I think we can avoid some form of deeper recession, 2026, and if not the first half, certainly the second half, I do think could see some growth.
And you think 305 is, forget the number itself, but the number reflects a level of optimism that I haven't heard from anybody.
And extrapolation. I mean, what analysts do, they'll generally extrapolate. I mean, for that matter, also 2025 at 277 that we started was also based on an extrapolation. So I'm not saying that 305 is a number that you want to sort of anchor yourself to. I'm just saying that number gets revised lower, but I don't think it's necessarily a 250. That number could be more like a 265, 270 in an environment of, call it, mild contraction, something that doesn't become sort of systemic. Because we don't have a credit issue at this point. We don't have a banking crisis. We have more of a big, massive tax cut, or tax hike, sorry, that's hitting potentially U.S. households, U.S. consumers. And then also we need to see how the corporates basically play out in all of this.
What am I supposed to do? I've asked everybody this, and I think everybody's thinking the same thing. What are we supposed to lean into in the market right now if you actually think, as I asked at the very top of the program, is the worst of the turbulence at least behind us for now?
I don't think we're out of the woods. I think the volatility likely persists for longer. Do we have to hit lower lows? Not necessarily. I think a lot of that depends on how the trade discussion, negotiations continue. We've gone from a very broad trade war to more of a concentrated China. Then China got some exemptions, but we're still basically looking at, I believe, $350 billion worth of goods that are not tax exempt, that are not tariff exempt. So just depends on how things play out. But I will say that time is of essence. And the more time that passes and that we sort of stay in this uncertain environment, there's a sentiment shock that could potentially magnify and start to spill over into hard data.
Are you surprised in any way relative to how you would have probably naturally come into the year feeling a little more bullish about the administration and what, you know, was lying ahead of us, which I think consensus was pretty bulled up on all of that. Are you surprised with the willingness, what seems to be a willingness to let the equity market go down to some degree more than you probably thought and let the economy deteriorate to a level that you otherwise and initially wouldn't have thought would have been possible? And I'm talking on the administration's part.
I am surprised. I did think that from the get-go, this is going to be probably part of a broader negotiation. I didn't expect things to go as far as they did. And I think the issue here is, well, first of all, we're starting from a very healthy spot when you think about balance sheets, when you think about credit. But the problem is that if you, I think, push it too far, you could then potentially start to face unintended consequences that tend to be more non-linear in terms of impact. And that's where you're basically dealing with a potential fallout or bigger downside risk.
Dubravko, when you think about the sequence of fiscal policy, now there's the belief that the tax bill comes in to save the day. That tax bill might not look like what we anticipated it to look like at the beginning of the year. How are you modeling that in?
No, so we're modeling it with a very fat standard error around it. So yes, we don't know how exactly the sausage is going to get made and what's going to be the ultimate output in terms of not just the original sort of tax bill, but they're talking about potentially tax exemptions for, you know, overtime income, tip income. Some of those things could be quite powerful for people with most need, where balance sheets are getting the most affected negatively. So we don't know how that's going to play out.
Good for Main Street, not for Wall Street, right?
Broadly, yeah. But at the end, I think the issue still, I think, remains right now, how the trade discussions are going to play out. China, I think, remains a big one, and especially China is important, I think, for a lot of U.S. businesses, small cap businesses, private businesses, mom and pop shops, right? Their margins are getting potentially wiped out if these tariffs stay in place. And so I think the big ones are probably going to be better off because they'll have pricing power. Josh talked about some very interesting names. There will definitely be resiliency in some segments, but the small segments of the U.S. economy, I think, get hit pretty hard. So that's why time is of essence. And yes, I think we need to see more progress. That's a question mark.
You have a really, I think it's fair to say, a defensive bent in the market, obviously. You're overweight utilities, staples, healthcare. I mean, there's three hallmarks of defensive: real estate, for example, aerospace and defense. Yes, comm services is on the list, but neutral to both tech and financials. Why?
Well, because I think the asymmetry is much better for some of these, what I would call low-vol, bond proxy defensive names. Because, again, I think that they give you pretty decent protection on a relative basis in any kind of downfall. And I think in an environment where perhaps rates come down some, because of Doge, because of some of these government cuts and so forth, I think these names can also do quite well. So in other words, if we're moving away from this higher for longer, I do think that all of a sudden a lot of these, what I would call bond proxy names, valuation-wise start to look more appealing, and they do give you that downside protection. Having said that, I do think that as part of the big momentum crash that we faced earlier this year, a lot of good, high-quality names have gotten hit. So I do think this is an environment where you do think about doing some bottom fishing, but not in value, in good quality businesses. And so like when Josh talks about a Netflix, when you talk about some of the Mag 7 names, you think about 2026, 2027 earnings resiliency, and there you potentially could have some interesting value.
I mean, someone who's been a value person who's been putting a lot of money to work lately.
In some of the growth names, because I've just bought Meta, for example, because it was down 33%.
But you continue to lean into the financials, so I know. What did you want to ask?
Because I do want to ask a question, though. You talked about resiliency. Have you been surprised at how strong the consumer has hung in there? And what does that do to your forecast? Let's just say they stay okay. They're not happy. Sentiment's terrible, but they still are spending, and they have jobs, and they have wage growth. So that's a big part of the economy as a whole. So I kind of find it hard, if the consumer stays strong, to see a recession. I'm
having a hard time deciphering the data that we're seeing. I don't know what percentage of the current activity that seems to be relatively resilient is a function of front loading. So I don't know if the true effect, once you sort of strip the strip these sort of the headlines and some of these like seasonals or one-off factors, I don't know what the true effect is. Maybe the actual pictures.
But we have seen a very strong consumer over the last several years.
No,
everyone
there's no
thought
question.
that they were dying.
Yeah, but that doesn't mean it lasts that way just because it was good. Doesn't mean it will.
If they have jobs, they will.
Gary Cohn was saying a lot of the same thing about the front loading when he was on within the last hour. It's just hard to know. It's also hard to know where soft data ends up being in the hard data, as the Fed is trying to figure that out as well. On that note, before I let you go, how many cuts do you think we're going to get this year? How do you think about Fed movement relative to what your expectations are for the market?
So we've basically pushed out the first or the next Fed cut to basically third quarter. So we pushed it out a bit. So we do think the Fed starts to ease, but sort of 3Q, and then continues thereafter. From everything we're seeing so far, it looks like the Fed is still very much so anchored around the whole inflation story. And we're seeing anecdotally more and more businesses using the current environment to potentially introduce a bit of a price hike. And so I'm not sure I would be counting on the Fed right now. I think we really need to sort of see if the Trump put is still alive. It looked like it was alive sort of at that 4,900 level.
Yeah, at lower levels than people thought.
Right.
That's fair.
Yeah, but
right?
because I think at the same time, President also came out and said sort of we're disregarding the stock market in the near term.
Yeah. But well, the bond market's calling the shots. Let's not kid ourselves. I mean, we know that the bond market tantrum of a handful of days ago made a big impact on a lot of people. I'll just leave it at that. Dubravko, thanks for being here.
Thanks
it's good
for
to
having
catch
me.
up with you again. Dubravko Lakos, JPM.